And now we get to pivot to our favorite topic of China and Asia as the unknowns continue, and we like to try to stay in front of what is happening in the region, what is going to be the biggest driver. And as we said before about the balloons and the other types of things, and I think Trivium said it best, it's each country spies on each other. I mean, are you doing it through balloons? Are you doing it through high altitude airplanes, drones, satellites? Again, in terms of the risks of what they saw versus what they would have seen from a satellite, is it good? No. I mean, obviously you were caught, and so you shot it down. But realistically, it's the nature of geopolitics, and as much as it's going to have some tit for tat. Blinken's going to cancel. China was slow to pick up the phone. Again, like they're going to shake a saber, but again, we don't think that's going to lead to anything much bigger. It's also an opportunity for the U.S. to distract from some of the issues within the NSC, with Norfolk Southern, with the spill. That's not grabbing headlines the same way as this. It's also a way for China to kind of cover some of the tracks that they have in some of the data sets, because some of them are good, some of them are a bit light, and there's that back and forth. So again, everybody's going to use something to their own advantage. Now, CPI was higher than previously, but in line with expectations. PPI came down a bit, expected to be at negative 0.5, came in at negative 0.8. Aggregate financing, slightly better. So you saw some of the money supply increase on an M2 level, but shrink on an M0. So again, kind of a bit of back and forth. New loan growth increase, which also brought in some additional M1. All of that is a positive, especially when you look at new loan growth. But the question is, how much of this was driven by special purpose bonds that were being pushed into the market? And how much of that is going to continue given some of the problems that we've highlighted on just the level of demand for it, which is a bit lackluster, as well as the leverage ratios that already exist for both the corporate as well as consumer side. Then you look at lending term rates from the PBOC. They kept things fairly stable. We do see a triple R cut coming, but it's just to inject some additional liquidity. We don't see too much of a movement one way or the other when you look at some of the activity. Now, new home prices month over month are flat. They're no longer negative. That is a positive. The problem is, because of the losses people took, you're going to have to see a much larger shift in new home prices to really try to wake people out of their slumber when you're looking at spending. Now, some of the key areas when you look at the Central Economic Work Conference that came in December, Xi had some interesting comments. So we need to make sure that the first-rate foreign investment already in the country stays in the country, as well as attract more high-quality foreign investment. So FDI, the foreign direct investment, is a big concern right now because we've seen a lot of outflows, especially as Xi has been a bit more aggressive on cracking down in the private sector. There's been more influence from the CCP in the private sector, and then the dual circulation and the movement to try to create some stability and trying to, again, move people to spend more. There's a concern of, well, are you going to take my profit to give it to these consumers? And that's where you're starting to see some of these fears and hesitancy to bring in additional. So what does he want to do? Expand market access, optimize business environment, and do better a job servicing foreign investors. That is nicely said, but going to be hard to achieve given some of the contradictions in general. The two top concerns for foreign investors are increasing policy volatility, rising geopolitical risks, as well as foreign companies will remain tepid on investing in China. The other key component is, Xi has promised to deepen SOE reforms and improve their core competencies while simultaneously optimizing the environment for private enterprise and promoting private sector development. So you're still going to provide SOE with support. But you're going to keep them competitive, but you also want the private side to come through. You already have steep deficits at the CCP, at the federal government level, the provincial government level. So state-owned entities would pay into that, but you're going to want to give private side, more opportunity. And again, there's just this back and forth that remains kind of counter to where things are. And given his track record and continued to support for SOEs, as we mentioned, Xi's promises to support the private sector are unlikely to provide people with this comfort that, okay, now's the time, he's really pivoting, and that's going to be a concern. China's CPI, as you can see, that acceleration. And when you look at it, it's what we've been saying is nothing goes up in a straight line, but you're seeing that gradual move up. And the bigger issue is on that China core CPI side. Obviously, you had a bigger increase in retail sales as people woke up from their slumber, from being in lockdown. So there was that big makeup. So that was also going to drive some of those CPI numbers. So February is going to be important to kind of confirm the trend, or is it just a sideways move? And some of these increases were just driven because of the reopening. Based on what we're seeing, I'm going to lean towards a lot of this was driven just by the reopening, and that CPI just doesn't really go anywhere. It just kind of goes sideways. If anything, trends down a bit from the current levels. Now, most provinces are still being cautious about growth in 2023 because they still see the problems that are there from the real estate side, the real estate, as well as asset sales and land sales. Like, you're just not seeing a lot of these different pushes, but China is being very aggressive on the food front. They're trying to promote more rural crops, more local consumption. Local growth. And we're going to talk about that, in the food show, because it's going to be an important piece, because China needs to diversify their supply chains, and that is coming front and center. And I think the India data that came out really highlights how important that's going to be for China to have a real recovery, which we think is going to come in spits and starts. China is likely to target a 5% GDP growth in general. But again, when you look at the provinces in terms of target cuts, it's going to be difficult to see that kind of growth. And again, they were low last year, so year over year isn't as hard. But what is that real month over month? What is quarter over quarter? And that's where we see some of these bigger headwinds. Chinese PPI still remaining in contraction, but when you look at Chinese PPI, it's going to be a benefit for the U.S. because and others, because we're an importer. So as PPI comes down, as CPI kind of levels off, it means that we're going to import less inflation and be a net beneficiary, which is a positive. And it's something that China is going to want to promote because exports are going to be fundamental for them trying to hit a very difficult GDP target. China's monthly new loans, you can see the survey was for 4.2 trillion, came in at 4.9, starting off the year with a bang. But when you look at aggregate financing, survey was for 5.4 trillion, actual came in at 5.98, and it came in just below 2022 levels. So it's starting off strong, but we knew it was going to because of the lockdowns. You had a big slowdown because of that. You had a lot of slow moving. So there was some of that pent up demand. There was some of that pent up supply that was able to get pushed out in January. We just don't think this leads to a much bigger trend because of the leverage ratios that currently exist, not only at the consumer and corporate level, but also at the provincial and provincial government as well as bank level. It's going to be difficult to maintain this level of growth at this point in time. So when you look at M2 money supply, you see it accelerating. But this is when you start looking at the PBOC, because they're also concerned about inflation. There's also a lot of inflation still in the world. So you also don't want your money supply to run too hot. And that's going to be that balancing act, which is why it's going to be difficult to see that big pickup in special purpose bonds, that big pickup in releasing this monetary policy. And Chinese exports, when you look at the backdrop in general, are still in contraction. Exports and imports in US dollars % year on year versus PMI manufacturing new orders are showing a decline. And that's when you start looking at, again, the strength of the Chinese recovery, because the export market is obviously fundamentally strong and an important piece. It was obviously when China, then the Chinese GDP gross number was much smaller. Exports were over 20% of GDP. As the GDP has gotten bigger, exports are now account from anywhere between 12 to 17%, depending on the month, averaging about 15% to GDP growth. But that's still a real number, especially given the sheer size of that. But your manufacturing new export orders are still in contraction, even after the reopening, even after the abandonment of the zero COVID policy. And that's the fundamental problem that we see, is because we don't see local demand. We don't see a big pickup in exports, and that's going to hurt manufacturing. That's going to hurt some of these different pieces, which again is going to be a problem. You also have China and Xi saying that he wants to increase the quality of Chinese-made products, and which means that he wants to make made in China a proud thing instead of, oh, well, it's made in China, therefore it should break. But that's a cost. It costs more to make quality because you need better raw materials, you need better manufacturing, you need better equipment, you need better just stuff to go into the product and the process, which increases cost. So as costs go up, what does that mean for their growth? But at the same time, there's a view that because even within China, buying made in China is not seen as a good thing. You're typically the wealthy still don't buy Chinese goods. So the idea is that, okay, well, we may lose some exports, but we'll gain imports. We'll gain local demand. And that's, I think, some of the problem that we continue to see in general. So when you look at growth of outstanding bank loans, you can see it was driven by enterprise. Household is still steeply negative, and that's what we keep talking about with leverage. Enterprises have bounced, but they've been fairly flat so far, and it's going to be difficult to see some of that come through. Now, capital outflows have slowed from China, but they're still not positive, and that's what Xi is trying to adjust, because FDI, or foreign direct investment, is an important piece of the Chinese GDP growth. And as we said in segment one, with the nearshoring, onshoring shift, we just see this as a much bigger hindrance for underlying growth. So now when we turn to India, industrial production, as we said previously, came in at 5% versus the estimate of 4.3. It wasn't as high as November, but again, still very good. The problem that we're seeing, and as we talked about last year, was that CPI was going to reaccelerate. And you saw inflation go from the estimate of 6% to come into 6.52%, well above the RBI target. Wholesale prices also accelerated versus the estimates. They expected to be at 4.5%, came in at 4.73%. Again, that is the problem that we've seen in terms of that reacceleration, which is the concern of, well, how are they going to continue to stimulate? Which is why we've been saying that we think Indian rates are going to go higher, and that's a bit counter to what the market expects, where it's not that anyone expects a cut. They just expect nothing to happen in the RBI to stay firm. We think that this is going to give some concern to where is inflation going, especially as you have the drop off of several several COVID era programs, which brought down the price of food as food continues to accelerate higher. Exports year on year came in at negative 6.6%. Imports came in at negative 3.6%. So again, better than what was expected. The trade balance was a bit tighter, but imports still remain a bit stagnant. And again, that's where we see some of this underlying pressure as we go through the remainder of this year. Money supply in South Korea shrank again in December. Import price index year on year in January rose 1.7%. Month on month, it was down negative 2.3%. Export price indexes coming down, which is a positive for, again, the importing entities. As prices come down, you're going to expand some of that disinflation, which is a positive. Now, just putting the India increase into context, you see that there's always a spike in December. This one happened to be the best ever. Now, the question is going to be, as inflation takes hold and you see more pressure and that slowdown on exports really kind of bites, how does that result in industrial production, especially as inflation continues to accelerate? As you can see here, you got that spike back up, with a large part of it being food and beverage. Inflation surged to 6.5% year on year. That was higher than both forecasts and consensus. And again, people were between 5.6% to 6%. And we were saying that it was going to be well above that. Food inflation surprised on the upside, rising to 6.2%. The surprise was driven by a jump in cereal inflation, 21.1% of the weighted basket. And again, that was because the government's decision to provide the poor with free rice and wheat from January. There was a view, and I shared it with people on the YouTube channel podcast, that we thought that they were going to try to cap some of that, but as you can see, it just wasn't enough. And that's a big problem when you think of this number, this increase was with a different form of stimulus, and that was, I should say, of support by giving that. But it appears that the government's decision to discontinue a broader pandemic-era policy of free rice and wheat resulted in the increase. So it's that back and forth that we continue to see. And as we've talked about multiple times, as emerging markets take away some of these pandemic-era subsidies, it's going to have an inflationary pop to it, and it's going to have a detrimental carry through to local consumption, which is a much bigger concern. And then when you look at core inflation, remained flat at 6.4%, another measure of core inflation, again, showing some of these remaining elevated. And then when you look at the RBI's renewed commitment to bring down elevated core inflation and its February review, it's a stance on, realistically, there's a strong case for further rate hikes, which we think is a likely setup. And this just puts it into context in terms of what really drove it. Food and beverage, cereals and products, milk and products. When you look at fuel and lighting, that's not going down anytime soon. Clothing. And then core inflation, when you look at some of the different pieces, housing not coming down all that much, clothing, fuel and lighting, and then the same things that are impacting other areas, not just the levels of growth in different regions. It's continuous, and its asset prices rose around the world, and now you have to try to bring them under control, and that's why they went up around the world. They have to come down around the world. And that's, again, going to drive some of these different risks. Japanese machine tool orders coming in below 2022 and 2018 levels. And then when you look at the BOJ, QE is now greater than the Fed QT. This is going to be a problem. The BOJ's quantitative easing is more than offsetting balance sheet reductions by other central banks. It's not sustainable. I can't put it any cleaner in the sense of they are going to have to yield. And that's why we think there's a massive amount of risk in the BOJ in Japan. RBI policy rates, again, kind of cycling back into the inflation side. On the Indian piece, there's the forecast that rates don't go up. And again, we continue to say that we think there is another increase. And then when you look at wholesale price indexes starting to flatline, and we see some of that pressure to the upside. And speaking of upside, Japanese PPI expected to be at 9.7, came in at 9.5. The elevated amount, Taiwanese core CPI was expected at 2.86, came at 2.98. This inflationary cycle is picking up in Asia, and that's why the BOJ is going to struggle and essentially have to yield and raise rates to try to bring this inflation under control. South Korean export prices, just putting into context where it is, it's back to the lower end, but a lot of that is because there's a slower buying, inventory builds, and that's, while it's a good thing on one side, it's also showing some of that slowdown in the economic growth front. So that's what we have for you today. If you have any questions, please feel free to reach out. We covered a lot, and should be a little bit shorter, which is a positive, but we love to hear from you. Please like, share, subscribe. We appreciate your support. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Prime Vision Network.